The European Central Bank must keep raising interest rates to fight off inflation, even if the probability of a Eurozone recession has increased, ECB President Christine Lagarde said in an interview published on Tuesday. The central bank's interest rates have a cascading effect across the Eurozone and directly influence the rates that commercial banks offer to households and businesses. Mortgages, car loans, and credit cards will become more expensive and less attractive as a result. Governments will have to make higher payments for their national debt, worsening their public deficits. Average debt in the Eurozone stood at 94.2% of GDP at the end of the second quarter, with Greece 182.1%, Italy 150.2%, and Portugal 123.4%, topping the list. The decision to raise interest rates was confirmed on Thursday afternoon, following days of speculation around the size of the increase, and will take effect from November 2nd. It marks the third hike this year for the 19 European Union countries that use the euro. Like other central banks around the world, the ECB is taking action to make spending more costly for both consumers and companies to bring down soaring prices. But the fight against inflation is expected to be painful. High interest rates can constrain demand, investment, and hiring, causing the economy to slow down. The ECB appears determined to push through these concerns and fulfill the bank's central mandate of price stabilization, a goal that the Ukraine war and the energy crisis have turned into an uphill struggle. Annual inflation in the Eurozone reached 9.9% in September, an all-time high figure and almost 5 times the 2% target pursued by the ECB. The 3 Baltic countries showed inflation rates beyond the 20% mark. The upward trend initially affected energy bills, but has now spread over food, alcohol, industrial goods, and services. In her first speech before lawmakers, Italy's new Prime Minister, Giorgia Meloni, criticized the ECB's successive hikes of interest rates, arguing they have created additional difficulties for those member states which, like us, have a high public debt. Meloni also spoke of rash choices made by the Frankfurt-based bank. The issue of debt reduction is at the core of an ongoing review of the EU's fiscal rules, which remain suspended since the outbreak of the COVID-19 pandemic. French President Emmanuel Macron, whose country carries a 113% debt ratio, has also expressed reservations about rising interest rates. I'm concerned to see lots of experts and certain European monetary policymakers explaining to us that we need to break demand in Europe to better contain inflation, Macron told a national newspaper. Lagarde brushed off the criticism when specifically asked about it on Thursday, arguing that we have to do what we have to do. A central bank has to focus on its mandate. Our mandate is price stability, and we have to deliver that using the tools that are most appropriate and most efficient, she went on. She stressed that the central bank is not oblivious to the risk of recession, but that under the current circumstances the decision we made today is the most appropriate. The ECB is an independent institution from member states and is only accountable before the European Parliament, shielding it from political interference. The next monetary meeting of the bank's governing council is scheduled to take place on November 15th, with a fresh hike of interest rates on the table. The last time interest rates were so high in the Eurozone was 2008, when the ECB tightened its policy to fight the financial crisis. The move, however, backfired and was quickly reversed. In the following years, the Eurozone experienced a rapid decline in interest rates until reaching negative territory. It wasn't until July 2022 that rates were brought back to positive levels. Are we going to see history repeat itself with the recent interest rate hikes? Can a new way of solving the recession problem be implemented without having to raise interest rates, since according to history they don't work out well? Let us know what you think in the comment section, and don't forget to like the video, subscribe and turn on notifications.